How China built the world's second largest banking system. In 2008, while American banks were collapsing and European governments were scrambling to prevent total financial meltdown, four Chinese banks quietly became the four largest banks on Earth by market capitalization. Not gradually, not over decades, in less than 10 years. This wasn't supposed to happen. When China opened its economy in 1978, its banking system was essentially one giant government accounting department. There were no private loans, no mortgages, no credit cards. Money didn't flow, it was allocated. Fast forward to today, and China's banking system holds over $55 trillion in assets. That's roughly the size of the entire American and Japanese banking sectors combined. So how did a country that didn't even have a functioning banking system 4 decades ago build the second largest financial infrastructure in human history? And more importantly, why does almost nobody outside China understand how fragile the whole thing actually is? The story starts with a problem most countries would kill to have: too much money and nowhere to put it. In the 1990s, China became the factory floor of the world. Exports exploded, dollars poured in, and Chinese citizens, having lived through famine and chaos, started saving like their lives depended on it. The savings rate hit 50%. For context, Americans save around 5%. But China had a financial system designed for a command economy, not a capitalist one. State-owned banks existed to funnel money to state-owned enterprises, whether those enterprises made sense or not. Profitability wasn't the goal. Employment was. Stability was. By the late 1990s, this system was buckling. The big four state banks, Industrial and Commercial Bank of China, China Construction Bank, Agricultural Bank of China, and Bank of China, were technically insolvent. Non-performing loans, meaning loans that would never be repaid, made up nearly 40% of their portfolios. Any normal country would have let these banks fail. China did something else. In 1999, the government created 4 asset management companies, bland names for what were essentially financial garbage trucks. These companies took 1.4 trillion yuan worth of bad loans off the bank's books, just absorbed them. The banks got clean balance sheets overnight. The bad debt? It disappeared into a corner of the state-owned system where no one asked too many questions. This set a precedent. When Chinese banks have a problem, the government solves it, not through bankruptcy, not through liquidation, through creative accounting and state intervention. And this is where things get interesting. After the cleanup, China did something unexpected. It opened the banks to foreign investors. In 2005, Bank of America bought a 9% stake in China Construction Bank. Goldman Sachs invested in ICBC. The message was clear. We're reforming, we're modernizing, we're playing by international rules now. The banks went public. Their stock prices soared. By 2008, when Lehman Brothers was imploding, ICBC became the most valuable bank in the world. Western analysts marveled at the speed of the transformation. Here was proof that state-directed capitalism could work. Except the transformation wasn't quite what it seemed. Chinese banks didn't succeed because they became better at evaluating credit risk or managing capital. They succeeded because the government told them to lend and told borrowers to borrow and kept the whole cycle spinning faster and faster. After the 2008 financial crisis, when Western banks were shrinking their balance sheets, China launched a $586 billion stimulus package. The banks were ordered to lend, and they did. In 2009 alone, Chinese banks issued $2.7 trillion in new loans. That's more than the entire GDP of Italy. Where did the money go? Infrastructure, highways, airports, high-speed rail, entire cities built in regions with no population to fill them. The projects looked impressive. Many of them made no economic sense. But it worked in the short term. China's economy didn't collapse during the global recession. Growth stayed above 8%, the banks kept growing. Everyone won. Except the debt kept piling up. Here's the uncomfortable math. China's total debt, government, corporate, and household, now stands at roughly 300% of GDP. For comparison, the United States is around 260%. Japan, the world's most indebted developed nation, is around 400%. But there's a difference. In the US and Japan, most debt is owed to private creditors who, in theory, can demand repayment or force defaults. In China, most debt is owed to state-owned banks, which are controlled by the government, which also controls the borrowers. It's a closed loop. This creates a strange paradox. Chinese banks have non-performing loan ratios around 1.5%, according to official figures. That's impossibly low. American banks, operating in a much more transparent system, have NPL ratios around 1%, and that's considered healthy. So either Chinese banks are the best risk managers in human history, or the numbers aren't telling the full story. Independent analysts estimate the real non-performing loan ratio in China is somewhere between 6 and 10%. Some say higher. If that's accurate, Chinese banks are sitting on over $3 trillion in bad debt. That's more than the entire banking system of Germany. But here's the trick. None of it matters as long as the government keeps the system stable. There's a concept in Chinese finance called extend and pretend. A loan goes bad, the bank doesn't call it a default. The bank extends the loan. The borrower takes out a new loan to pay the interest on the old loan. The new loan is counted as performing, the old loan stays off the non-performing list. Everyone pretends the problem is solved. This works until it doesn't. In 2021, Evergrande, one of China's largest property developers, defaulted on over $300 billion in debt. The collapse should have triggered a wave of bank failures. It didn't. The government stepped in, restructured the debt, froze parts of the property market, and quietly absorbed the losses across the state sector. Then Country Garden, another giant developer, hit the same wall. Then others. The government's response? More intervention, more extend and pretend, more bad debt shuffled into corners where regulators don't look too closely. This is how Chinese banking system actually works. It's not a market, it's a managed system where the government decides which failures are acceptable and which aren't. And so far, it's held together. But there's a cost. Chinese households, the ones who saved at 50% and built this system, are losing faith. In 2023, for the first time in decades, bank deposits in China fell. People stopped saving. They stopped investing in property. They started moving money offshore. The government responded with capital controls, limiting how much money citizens can move out of the country. But controls only work when people believe the system is stable. And belief is a fragile thing. The irony is that China built the world's second-largest banking system by doing everything Western financial theory says you shouldn't do. It kept bad banks alive, it directed lending for political purposes, it fudged the numbers when convenient, and it worked for decades. Now the question is if the model can survive the next crisis, because at some point the math has to reconcile. Either the bad debts get written off, which would wipe out capital across the system, or they keep getting rolled forward, which means growth slows to a crawl as more and more resources go towards servicing old obligations instead of funding new productivity. Chinese banking system isn't collapsing, but it's not exactly thriving either. It's in a kind of stasis, held together by state power and collective agreement not to look too closely at the cracks. Which raises a final question. If a banking system this large, this interconnected with global trade and investment, ever cracks, what happens to everyone else? We don't know. And maybe that's the most unsettling part.